Hello, welcome back to the Retirement Income School. I'm Dr. Amanda, and this is your place for financial education to learn how to protect your wealth and create guaranteed lifetime income so you can retire financially relaxed. And today I'm really thrilled to have on a guest, Tom Hegna. Tom Hegna is an economist, author, and one of the most respected voices on retirement income planning. He's best known for his books, Paychecks and Playchecks, and Don't Worry, Retire Happy. These are both books that you're absolutely going to want to read. I'll have links in the show notes. And he's educated and inspired me, along with many other financial planners across the country, to design retirement plans centered on guaranteed income. Tom is a retired Army Lieutenant Colonel, a former first Vice President at New York Life, and a sought-after speaker who has delivered hundreds of presentations showing people how to simplify what can feel like a very complex subject. As you know, we've discussed here on the Retirement Income School many times. Welcome to the show today, Tom.
Thank you, Dr. Amanda.
Yeah, so excited. Just a little backstory for everyone before we get started. This is a really, really cool day for me. I ran into Tom Hegna at an event that I was at. Of course, he was talking about retirement income, and I gave him a huge hug because he is one of the reasons why I do this work. I ran into Hegna and I read all of his books, and I took his courses and his trainings, and he really inspired me to help other people with guaranteed lifetime income, because when my dad passed away and my mom had an annuity, it made everything simple and easy, and she was able to not have the stress of finances on top of having my dad pass. They'd been married for 51 years. And so, reading his books and talking to him, you're going to hear his inspiration and the way that he helps you plan for retirement in terms of thinking about longevity risk, sequence of returns risk, market risk. There's just so many different things that he's helping us to understand. And so that's why I wanted to have him on the show today. So I've heard you say many times in retirement, every day is like a Saturday. Will you tell us what that means?
Well, if I were to ask your listeners, what day of the week did they spend the most money? What day of the week to go golfing? You get your hair done, get your nails done, go to Home Depot. For most people, that day is Saturday. Well, the day you retire, every day is Saturday, all right? And so many people are going to end up spending more money in retirement, not less, and they don't realize that. And I think Dr. Wade Faust done a good job of talking about the retirement smile. And if you think of a smile like this, that when you early in retirement, you may spend more. And then when you get in kind of your slow-go years, 85 or something, then you might spend less. But then if you live in your 90s and longer, you might have more healthcare costs. And so, I always say there's three phases of retirement: your go-go years, your slow-go years, and your no-go years. In those go-go years, and I'm in my go-go years, it's all about spending money. It's about traveling. We just got back from a Viking cruise from Budapest to Amsterdam. We're scheduled to do a Panama Canal cruise in the spring. And, I couldn't justify a country club membership for 30 years because I was on the road for 200 days a year. It made no sense. Well, now I got two country club memberships. I'm up here in Flagstaff during the summer, and then I'm down in the Phoenix area in the winter. But retirement's all about spending money. And the problem is, you got two types of people. You got spenders and you got savers. I'm a saver. I'm not a spender. So how do you turn a saver like me into a spender in retirement? It's very hard because most retirees underspend. They don't overspend. But what I found for me, I own 13 annuities. I don't sell any annuities. I buy them. I own 13. And when I get these paychecks and playchecks coming in, I'll spend the paychecks and playchecks because they never run out. They're guaranteed to me for the rest of my life. And I don't have to go into my savings and investing. And that's the one thing that most retirees don't like to tap into their savings, because what if the market crashes? What if I live a long time? What if this happens? What if that happens? And so what the annuities have done for me is given me peace of mind. And the average payout on my annuities is like 9%. So why would I even worry about being in the stock market with that money when I'm guaranteed this money for the rest of my life? So for me, the math and science backs it up as well, and we can talk about that too.
Will you share why you own 13 annuities and not just one, for people that might not understand why?
Well, because every time I got 100, 150,000, I bought an annuity, and then I get another and I buy another one. And I've got them laddered. So some of them have been sending me income since I turned 60. Some will kick in at 65. Some will kick in at 70. Most of them kick in whenever I want. I can start them whenever I want. And so I've got several in reserve. But what I found is, people say, well, what about inflation? Annuities don't protect against inflation. Well, if you only buy one annuity and that's it, well, then you could argue that. But I own 13. Boom, boom, boom. I'm having increased income for the rest of my life.
Yeah, I think that's a really important part of thinking about annuity laddering for inflation hedging. And then also, I think it's important to point out the peace of mind part and having such a lifetime payout that's high. You said 9%. Dig into that a little bit more so that people understand what you're
Okay,
talking
so
about.
everything I do is based in math and science. It's not based on my opinions. It's based on the research of the leading PhDs in the world. And there's really three reasons why you want to put an annuity into your retirement portfolio. I'm not saying put all your money. The research says 20 to 40% of that portfolio should be in guaranteed income. But there's three reasons why. Number one, it will improve your portfolio performance. Because of the mortality credits in income annuities, they're going to pay you more than bonds. So if you have a 60% stock, 40% bond portfolio, if you just change that to 60% stock, 40% annuity, you're going to do better. Okay. So, and BlackRock says this, BlackRock wrote a whole white paper and BlackRock sells no annuities. They got 11 trillion in the market, but they say if you add guaranteed lifetime income, you can take a more aggressive stance on your investments and you can have 29% more growth with 33% less risk. Well, why wouldn't somebody want to do that? Ernst and Young, they're an accounting firm. They didn't sell any annuities, and they said, okay, let's put our AI and our smart people together, and they came out with the optimal portfolio. You know what it looked like? 30% whole life insurance, 30% income annuity, 40% investments. I'm not making this stuff up. So, number one, it will improve your portfolio performance. Number two, the research shows you're likely to be happier. And now the research shows you're likely to live longer as well. And so, if you got something that increases your portfolio performance, allows you to be happier. The Wall Street Journal had the headline, "The secret to a happier retirement is friends, neighbors, and a fixed annuity." Okay. Patrick Tricker wrote an article in the Journal for Financial Service Professionals. He's an attorney that if a 65-year-old man purchases a lifetime income annuity, they can expect to live about 20% longer than a 65-year-old male who does not. And explained all the reasons why people live longer. They have less stress. They have less worry. And because they're being paid to live, many of them choose to live differently. They watch what they eat, they exercise, they call the doctor not feeling well. All these little things cause them to live longer. So if it improves your portfolio performance, allows you to be happier, allows you to live longer, how could anybody be against that?
Yeah, it's so powerful. I can't remember if I heard it from you or just researching, talking about how when you have an income annuity, you are able to take more risk in your portfolio
Yeah.
because you know that you have that floor met. We talk a little bit about meeting the income floor with an annuity in combination with pension, social security, things like that.
Yeah. So what all the retirement research shows is that you should, as a minimum, this is the minimum, you should cover your basic living expenses with guaranteed lifetime income. So figure out what do you need every month to live your normal retirement. All right. And then you subtract out your Social Security. Why? Because that's a lifetime income annuity. It's a guaranteed paycheck for life. It counts. If you have a pension, subtract that out because that's a lifetime income annuity. But whatever the shortfall is between your basic living expenses and then your other government guaranteed lifetime income, whatever that shortfall is, that's where the annuity fits. That's as a minimum. That's the paycheck. Now, I also have some annuities for playchecks because we like to go on cruises. I like to, play golf. I like to go do stuff. And I want to have those checks coming in so I don't have to reach into my savings and investments to do it. And so I think those are really the reasons why you want to incorporate guaranteed lifetime income.
Yeah, you addressed this a little bit. I think it's fascinating the mindset around it where people get really stuck in the savings mode and they're afraid to dip into their portfolio. And so they end up tight, they don't want to spend, and then they don't have a fun retirement. They end up giving their money to their kids. And I've heard you say this before, and I think it's hilarious and so true. It's like, oh, they save all this money, they give it to their kids, and then their kids go buy a yacht.
So what I call that is living a just in case retirement.
Yeah.
And these are people in their 60s and 70s. They got plenty of money, but they don't touch it. Why don't they touch it? Well, the country's so divided. Well, the market could crash. I mean, markets at all-time record highs. That thing's going to crash pretty soon. Oh, there's a war in Ukraine. Oh, what's going on in Israel and Gaza? And then they let all this stuff. And so what happens is, and I said, wait a minute now, you're retired. You told me you were going to join the country club. You're going to buy a new boat. You're going to see the world. Have you done that? Oh, no, all these things are going on. So here's what it looks like. They don't touch their money and they don't touch their money and they don't touch their money. Then they die. What happens to money? Goes to the kids. Well, the kids are there. Oh, they join the country club, they buy a new boat, and they go see the world. This is happening all over the country. And what I want to make clear is this. You are not supposed to leave any money to your kids. You are supposed to spend all of your money. Leave them life insurance. You can do that for pennies on the dollar. I'll use me as an example. We got 4 kids. One day we're sitting around saying, hey, how much should we leave the kids? My wife said, I don't know. What do you think? I said, well, if we bought a $1 million second to die life insurance policy, name the 4 kids as beneficiary, when we're both gone, they're going to get $1 million tax free. That's 250,000 a piece tax free plus whatever's left over. I said, let's start there. So we bought that $1 million policy, named the 4 kids as beneficiary. That policy is completely paid up. The total cost of that $1 million policy was 150,000. So now think about that. For 15 cents on the dollar, we get to leave our kids $1 million tax free. But here's the best part. Who gets to spend the other 850,000? We do. Don't leave your kids money. Spend your money. Leave them life insurance because you can do that for pennies on the dollar.
I think that's so powerful because sometimes people think about only needing life insurance when you're younger to protect your family, but as a wealth transfer vehicle, there's a place in your portfolio for it. And so I think that's really important that you address that. You said something that I want to ask you to dive a little deeper. So 20 to 40% of your portfolio should be in an annuity. Say a little bit more there. Is there ever a case for more than that? Because sometimes clients that I work with, they might have an income floor that, the Social Security might not meet as high of a gap and they want to put more in a safe, guaranteed situation. So can you,
I
give
have
a case
more.
for more?
That's 20 to 40% of an income annuity. Deferred annuities, they could be considered in the same category as a CD or a stock or a bond or whatever. It's just another investment account that you're not getting income from that's growing that you can turn into income in the future. And I said I will probably have more than 40% of my money in annuity. I have 13 of them, but I do have a lot of money in life insurance. I just finished a 12 pay whole life. That's where you only pay for 12 years and you have it for the rest of your life. My annual premium was 226,000 a year. And so there's a lot of cash in there because all of those premiums are in there plus a bunch more. And so, anytime I want, I can flip on a switch and that money comes to me tax free. So I could get 10,000, 15,000 a month tax free just by flipping a switch. And at some point, maybe I will, but right now I don't have to, so I don't. But I'm a big believer in tax-free income because if you look, we're $37 trillion in debt. We're gaining $1 trillion in debt about every 90 days, and that'll probably go down to 60 days pretty soon. The interest on our debt is more than our whole defense budget. It's $1 trillion. It's unsustainable. And so something's going to happen. I don't know what's going to happen. Something's going to happen. I'm planning that taxes are going to have to go up a lot. I know Trump cut the taxes. That's temporary. I think taxes are going to have to go up a lot. And so I'm positioning myself to get as much tax-free income. Most of my annuities are Roth IRA annuities. So all that income is tax-free. My life insurance income is tax-free. And I would encourage people to look at that.
Yeah, one of the main strategies I use with clients is to do a Roth conversion using a Roth friendly annuity where they can do partial conversions year by year.
Yep.
And because that is a safe container where they're not going to have that phantom tax problem if they convert and then their portfolio goes down because in the annuity they can't lose. Sometimes I'll have people come to me and say, I hate annuities, or they hear the word annuity and they don't even want to talk about it. Will you talk about annuities from 10, 15 years ago compared to the annuities of today?
So I think the reason that some annuities got a bad rap is because, 15, 20 years ago, there were some bad annuities. There were annuities with 20-year surrender charges that they're putting 85-year-old grandmothers in that paid a 10% commission to an agent. Those are not in the best interest of that client. I don't think you're going to see that today. Today, there are so many really, really good annuities. Now, you still need to be careful because some annuities are better than others. And that's why you got to work with a financial professional. I don't think retirement's a do-it-yourself project. I know this stuff inside and out. I know probably as good as almost anybody in the country. And I work with 2 financial professionals because when it comes for time for me to buy a product, I don't follow every company and they change their products every 2 weeks and they change their interest rates. And I need somebody to sort through all of that. And I'll just be honest with you, I made a big blooper last year. So I had a pretty big IRA, it's like $1 million, and I converted it to Roth in one lump sum, all right? Which means about 400 grand in taxes. But what I didn't think about, I was 63 last year. I'll be 65 next year. I got to apply for Medicare. And you know what they look at when you're 65 or Medicare? They look at your income when you're 63. So I kind of screwed myself up. So I'll hit the IRMAA highest level and all that stuff. And that's another thing people don't understand. They don't understand that Medicare has like 6 different premiums. They all think, oh, it's $182. No, 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 no. That's for the lower income people. And the more you make, it can go up to like $700 a month or 600, but whatever it is. I mean, there are a bunch of steps. High. And if you're $1 over that one amount, you go up to that next amount. And so I think people need to really understand how Medicare and this IRMAA works. And that's, again, why they need to work with a financial profession.
Yeah, this is a great spot for a plug for everyone. If you want to talk to me about an annuity, doing a Roth conversion using an annuity, high cash value life insurance for income in retirement, then go to retirementincome.school, click on book a Q&A call. Retirementincome.school, book a Q&A call. That's how you talk to me about the exact same things that Tom and I are talking about here, creating guaranteed lifetime income for you that's protected, tax advantaged, and we break it down based on your unique situation. Talk a little bit about the safety of insurance companies, because that's something that I have a lot of people talk to me about, like, hey, if I'm going to put a lot of my eggs in this basket, what are my protections?
Yeah, so I do say in my books, all insurance companies are not created equal. You do want to deal with a higher rated carrier, whether that's, A or A plus or triple A, whatever that letter is for you, I would work with those companies or better. But then you also need to know there are state guarantees in every state that protect you up to a certain dollar amount. You can search that, you can Google that, ask Grok, ask GPT, what is the annuity guaranteed rate in our state? Normally it's like $300,000 per contract. But nobody that I'm aware of has ever lost a penny in an income annuity. Okay, so the income annuities are set up that the guarantees are so strong and the reserving requirements of that insurance company are so strong that even if that company fails, those income annuities are going to continue to pay. And with deferred annuities, so far what's ever happened is another company comes in and buys them for pennies on the dollar and takes over on their annuity. So I think it's certainly much safer than the stock market, much safer than crypto. I would say safer than the bond market. And for those people who think CDs and their FDIC insurance is so safe, I talk about that in Paychecks and Playchecks. When people would say, well, I want to buy CDs for the FDIC insurance, I said, okay, well, then let's go find the smallest, weakest bank in America, and that's where you ought to buy your CDs. And they said, what do you mean, smallest, weakest bank? And I said, well, there's this much of FDIC insurance to protect this much in CDs. There's not enough to protect Bank of America or Wells Fargo or JP Morgan Chase or any major bank. So the way I got it figured, if the economy turns and banks start failing, the smallest, weakest ones will fail first, and you got a shot at some of that FDIC insurance.
That's brilliant. It's crazy to think about, but it's so true. I often think about fractional reserve banking versus dollar to dollar ratio for insurance companies,
Right.
and how many protections you have that people don't really understand. And so I look at insurance as a really powerful asset class.
Yeah, it's a powerful asset, and it's
Yeah.
backed again by math and science. If you just do the
Yeah.
research, study the works of Dr. David Babbel, Dr. Moshe Milevsky, Dr. Menachem Yari, Michael Finke, Dr. Wade Pfau, Dr. David Blanchett, you're going to see a pattern. And the pattern says you've got to have some guaranteed lifetime income if you want to have an optimal retirement. And, rich people don't have to have optimal. They can do stupid things with their money, and then they'll still be fine. But even Warren Buffett would be better off with some annuities in his portfolio. He would be, and he'd be better off having some long-term care. He can afford long-term care just off the interest of his things. But why would you want to have $1 million, expense come out of your pocket when it can come out of an insurance company's pocket and you just pay pennies on the dollar? I just don't understand it. You
Yeah.
got to use the leverage that these insurance companies offer, that they'll pay it because they got the law of no large numbers. They insure 1 million people, only 100,000 are going to need it, and so that's why you get it at such a discount.
Yeah. This is a perfect segue into thinking about mortality credits. We talk about that.
Yes. So the secret sauce of annuities, the reason why you have to have income annuities in your portfolio is because of the mortality credits. Mortality credits are the secret sauce. So every check you get from an insurance company in the form of an income annuity is composed of three parts. Part number one is principal. Well, anybody can give you principal. Part number two is interest or investment gain. Anybody can give you that. But the third ingredient is the mortality credits. That's the secret sauce that you can only get from a life insurance company. And I call mortality credits a little bit of a financial miracle, because think about it. The insurance company doesn't know when I'm going to die, and they don't know when you're going to die, but they know how long everybody on this call is going to live, almost to the exact day. And because of that, they can pay each and every one of us as though they knew exactly when we're going to die. So they set the payout rate based on this law of large numbers, maybe 100,000 or 500,000 or 1 million people. They know how long those people are going to live. Now, half the people on this call are going to die early. Half the people on this call are going to live longer. We just don't know who's on which side, but we don't have to, because they set a payout rate based on the whole group. All right. And now, if you live shorter, you're not going to get as much money, but you'll get a fair payout rate for your whole life. But if you live a long time, you're going to keep getting that fair payout rate. And what they're going to do is they're going to take some of the money from the people who died early, they give it to the people who live longer, and that's called the mortality credit. So the older you are, the longer you live, the more of these mortality credits you get paid. But that's why income annuities pay more than CDs. They pay more than bonds. And that's why, the Wall Street Journal said the case for moving some bonds to annuities. Dr. Roger Ibbotson did an entire white paper where he studied annuities versus bonds, and he found that annuities have outperformed bonds for the last 40 years and are likely to do so for the next 40 years. Barclays, they don't sell annuities. They're an investment bank. They say annuities outperform bonds. And so if you just move the bond portfolio to annuities, you're going to do better. I don't know why people wouldn't. You're going to be happier and you can live longer. So I don't know why people wouldn't do that.
Yeah. I think it's a mindset over a long term, I would say
Well,
brainwashing almost.
yeah, well, here's the deal. They think annuities are expensive.
Yeah.
But the truth is, most annuities don't have any fees whatsoever. A single premium immediate annuity is not a fee product. A deferred income annuity is not a fee product. A multi-year guarantee annuity, a MIGA, fixed annuity, not a fee product. Base fixed index, not an annuity, not a fee product. There's only two types of annuities that even have fees. Variable annuities have fees, and some optional riders have fees. Well, if you don't want to pay fees, most annuities don't have them. So then people say, well, how does the insurance company make money? That doesn't make any sense. And I say, okay, let me explain it to you. If you go down the bank and you buy a CD, a certificate of deposit, you buy one of those, do they charge you a fee? No. Are they working for free? No. They pay you 4%. They're lending out to your neighbor kid at 9% interest on his car loan. They keep the spread. It's a spread product. Most annuities are spread products. If the insurance company guarantees you 5% a year for 6 years, if they don't make more than that, they lose money. They don't charge you a fee. And then people say, well, why should I let that nasty insurance company invest my money? I'll invest my own. You can't invest like an insurance company. They have a 100-year time horizon. They can buy a building that's not even profitable for 40 years. You can't do that. They get institutional fees on all their investments. You don't get that. And so the annuity was created specifically to help normal people. It's a personal pension plan. Like everybody loved their pensions. And I tell you, everybody loves their income annuities. People love their Social Security. Well, they're all
Yeah.
income annuities.
In my mind, I think about the fee for an income rider going into the pool that's paying for longevity and, say a little bit more there because I think it's important to understand fees and it's important to understand why you would pay a fee and that it can be beneficial in certain circumstances.
Absolutely. Like, all fees are not bad. You got to look at what's the value.
Yeah.
What is the value that you're getting? And if you're getting a value that's worth more than whatever that fee is, and that fee didn't really matter, that you're really looking at the value of that you're going to get, it doesn't matter. But what I'm saying is most annuities are not even fee products.
Yeah, yeah. Well, and I just look at the security of knowing that you have guaranteed lifetime income forever, even if you live to 105. I mean, the peace of mind there is absolutely worth that fee
Well,
in my
and
mind.
look at what's happening in medical technology with AI. They're having nanobots. Pretty soon you're going to go in and you're not going to get just, ibuprofen. You're not going to get just a medicine or an antibiotic. It's going to be for you. It's going to be based on your DNA, based on your age, based on whether you're male or female, based on all these different factors. What will work best for you personally, and that medicine will be made up for you. So people, I mean, they can cure heart disease, cancer. They're going to be making replacement kidneys, replacement hearts, replacement livers. And so if people start living to be 100, 110, 120, 130, Time Magazine said the first person lived to 140 is alive today. Think about that.
That's insane.
That's a lot of paychecks and playchecks I could get
Wow.
if I could live that long.
Yeah.
And,
Tell
and just
us.
let me explain, because
Yeah.
then people will say, but then the insurance companies all go broke if everybody's living on.
Yeah, I was going to
No,
go there.
because
Yeah.
they're hedged on mortality. See, they
Yeah.
sell both life insurance and annuities. Life insurance pays if you die young. Annuities pay if you live a long time. So if all of a sudden there's a pandemic and everybody starts dying, yes, life insurance is going to have to pay a lot, but they won't have to pay on annuities. If all of a sudden people live a long age, yeah, they're going to have to pay on a lot of annuities, but they're not going to be paying their death claims on life insurance. And so the insurance companies are hedged against this longevity risk. That's another thing most people don't realize.
Yeah, that's fascinating to think about. Tell us about the main retirement risks.
Well, there are a lot of risks. I mean, taxes could go up, the markets can crash, we can have inflation, You might need long-term care. You might die. You know, there's a lot of risk, but there's one number one risk, and that risk is longevity risk. Now, we all want to live a long time, but the problem is longevity is not just a risk, it's a risk multiplied of all the other risks. Because the longer you live, the more likely the market will crash. The longer you live, the more likely you'll raise your taxes. The longer you live, the more likely you'll see inflation. The more likely you're going to need long-term care. And so longevity is a great thing, but it multiplies all the risks. So you've got to take that longevity risk off the table. Well, stocks can't do it. Bonds can't do it. Bitcoin can't do it. Real estate can't do it. CDs can't do it. What can do it? Only some form of annuity with guaranteed lifetime income. Because no matter how long you live, those checks are going to be coming in. And so you've got to mitigate that longevity risk. And only some form of guaranteed lifetime income can do that.
It's so powerful to think about when you're saying people could live it to age 140. That kind of blows my mind. But I have more and more clients that will come to me and say, my parents lived to, 100, 103. And so we always talk about that longevity problem and the peace of mind that an annuity creates for them and having that guaranteed lifetime income. I know in your book, Retire Happy, you've got 7 steps to retirement security. Can you give a recap of those?
Yeah. So step number one, you got to have a plan. I mean, how can you get anywhere if you don't have a plan or a roadmap or GPS to get there? And then with this, I say you've got to work with a financial professional. Retirement is not a do-it-yourself project. Step number 2, you want to understand and maximize your Social Security benefits. For most people, Social Security is the largest retirement asset they have, and yet they spend more time planning their summer vacation than learning how to get the most of those valuable dollars. And I'll just summarize it. In general, the breadwinner should delay. Now, why do I say in general? Because, if both husband and wife have severe medical issues, maybe they should take it early. If you have minor children in the house, maybe you should take it early. There are specific reasons why some specific people should take it early, but in general, the breadwinner should delay. So if you have a husband and wife, let's say the husband made more money in his career than the wife can take her benefit early. The lower earning spouse, whoever that is, can claim early. I don't have a problem with that. But the higher earning spouse should wait till 67 or 70 if they can. Why? Because that check covers both lives. When he dies, which check does she get? She gets his. If he took his early, he locked her into a lower survivor benefit. Because that breadwinner's check covers both lives, in general, the breadwinner should delay. Step number 3, do what I do. A hybrid retirement. Instead of going cold turkey into retirement, I'm going to San Antonio tomorrow. I'm speaking down there. Next week, I'm flying to California. I'm speaking out there. Last week, I was in Providence, Rhode Island. But the week before that, we were on a 3-week cruise from Budapest to Amsterdam. So I'm still doing some things, all right? I don't do a lot. I play golf 4 to 5 days a week. I play pickleball 2 days a week. But, if you can just work a little bit, it can increase your success in retirement. Step number 4, you've got to have a plan to protect yourself against inflation. So you don't just want to have income, you want to have increasing income, which is why I've got the 13 annuities. I'm guaranteed to have increasing income for the rest of my life. Step number 5, you want to secure more retirement income. Retirement's about income. It's not about assets. You don't get to spend your assets. You spend your income. And so it's all about turning assets into income in the most efficient manner. So this step number 6, you must have a plan for long-term care. No retirement plan is complete without a plan for long-term care. This is the number one thing that most people forget about that can wipe out their entire life's work. Step number 7, use your home equity wisely. For most people, their house is one of the largest assets they have. There's several ways you can get money out of your house, all right? You can downsize and take the capital gains. For couples, it's $500,000 tax-free, single $250 tax-free. You can do a reverse mortgage. There's this new thing called Chiefs with the IE switched. It's flipped around where you can literally sell 10 to 50% of your house. You get the cash, you own no debt, you have no payments, nothing. When your house sells eventually in 10, 15, 20, 30 years, they're going to get half of whatever it is. You get the other half. They don't pay for your maintenance or anything. But I mean, to me, that sounds like a great deal that you can actually pull cash out of your house with no debt or no repayment. You're just saying, okay, they get half of it when we sell it. It sounds like a pretty decent deal. And then the most efficient way to pass wealth to children, grandchildren, and charities is with life insurance. Don't leave them money. Spend your money. Leave them life insurance. You can do it for pennies on the dollar.
Everyone watching on YouTube, this is the book where those steps are coming from. Don't worry, retire happy. I'll have the link in the show notes, of course. Also, we've been talking about Paychecks and Playchecks, both 2, I think, very important reads if you're interested in thinking about using annuities and life insurance as sources of retirement income that are guaranteed. Everything I talk about here at the Retirement Income School. In closing, is there anything that you would want to say as a takeaway? Just thinking about, you've been in this industry for a long time. You've probably seen everything from the mistakes people make. What would you say is the most important takeaway for people to know when they're doing retirement income planning?
Well, I think Paychecks and Playchecks had the best summary. Step number one, cover your basic expenses with guaranteed lifetime income. Step number two, optimize the rest of your portfolio to protect yourself against inflation. Step number three, you must have a plan for long-term care. And step number four, the most efficient way to pass wealth to children, grandchildren, charities is with life insurance. Now, one other thing I would say, if you've got kids, my latest book is for them. It's Tom Hegna's Who Wants to Be a Millionaire. These are the things I've shared with my own children on how to build wealth. I show people how simple it is to become a multimillionaire in America today. It is simple. And everybody's thinking, oh, these kids are not going to make it. They can't afford a house. I show them how they can become wealthy. And, I've got a 23-year-old. I know the job market's tough. The pay is low. The price of housing is high. I know that. But there is a way to become wealthy over time. And that's what I talk about in that book. And so that's good for your children and your grandchildren.
That's awesome. I'll put that in the show notes as well for everyone. Thank you for being here. And you're such an incredible wealth of knowledge. I really appreciate you. I feel very blessed and fortunate that I ran into you in the educational world and how many things that you've helped me understand about annuities and life insurance. So thank you for being here today.
Thank you all for listening.
That's a wrap on today's lesson featuring Tom Hegna. Remember that if you're interested in exploring some of the things we talked about during the show with Tom Hegna, using an annuity for guaranteed lifetime income, passing on wealth using whole life insurance, or even doing a Roth conversion using an annuity as the vehicle to convert from an IRA or a 401k into a Roth IRA, then go to retirementincome.school. Click on the book a Q&A call. You'll talk directly with me. We'll have an introductory conversation where you can ask questions, and if it makes sense, we'll move forward and build a retirement income plan for you. Again, that's retirementincome.school. Click on the book a Q&A call. If you have not yet subscribed to the Retirement Income School channel or podcast, be sure to do so now. Turn on that notification bell so you never miss out. And continue to stick with me here at the Retirement Income School, where I'll bring you financial education to help you protect your money and make it last so you can enjoy retirement. This content is for educational purposes only and is not financial, legal, or tax advice. Always consult a qualified professional before making decisions about your retirement.